Welcome guys, this is RP Forex with another Forex lesson. Today we're going to be talking about stop hunts and more importantly, how to avoid stop hunts in Forex trading. Picture this, you have used your trading strategy to find a setup in the Forex market. You have set your stop loss and take profit level. You place your trade and go out for a walk. Hours later, when you check on your trade, you see that your stop loss was hit. You head to the charts and notice that the market suddenly went out of its way to hit your own stop loss before going in the direction you originally thought it would go. New traders ask what gives, and it's very simple. This is called a stop hunt. You have been stop hunted. This is an unfortunate event. It's called a stop hunt, and a stop hunt is when institutions drive price for a Forex pair to a certain level that is favorable before reverting price back in the opposite direction. Now you may ask what benefit there is for this, so I'll give you an example. Let's say RP Hedge Fund was to buy 1 million euros because they believe the euro will get stronger and the next month and go to 1.26. The current price of EURUSD or euro versus the dollar is 1.25700. RP Hedge Fund knows that millions of retail traders have a stop loss at 1.25500. Therefore, RP Hedge Fund will push EURUSD to 1.25500, activating everyone's stop loss. Retail traders will then enter short on EURUSD, which will then help price push even lower. Now EURUSD is 1.2200. RP Hedge Fund will now buy 1 million euros and make a profit of 1 million times the future price minus the present price, and that's 10,000. Instead of making 1 million times the future price versus the entry price, which is 5,000. So there's a chance to double your profit, and this is what happens on a grand scheme in the Forex market. Now that we know what stop hunting is and why it occurs, we need to learn how to avoid them. So we have two guidelines for avoiding stop hunts, and it's very simple. So to do this, you need to follow these guidelines at all times. So number one, do not put your stop loss at support and resistance levels or common/psychological levels. So we know support and resistance by now. There are certain levels where price could not go higher or further, higher or lower. Now, do not also put your stop loss at common or psychological levels. So many people would like to put stop losses on EURUSD at 1.10,000, and that's a very, very easy place to get stopped out, or numbers like 0.9999. Certain levels will attract stop hunts more than others. Number two, do not put your stop loss at any random level. Make sure it's devised from your strategy. Don't just choose a random number or 20 pips away from where you are. Make sure each level has a reasoning behind it. Now we'll take a look at an example to better your understanding. So here we are, traders. We're on USD yen, and this is a classic example of a stop hunt. So let's go through what actually happened here. So we see, a chart with its levels, its support and resistance levels down. Very common chart of what a beginner chart would look like. Now, most beginners will notice that we have a support down at 107.918. And so they see that in the past we've had rebounds from this level to go higher. And so that's what retail traders will look for in this setup. They'll look for an opportunity to take price to the next level. And obviously if we're looking for buys down here, we expect USD yen to maybe go to this resistance followed by this resistance. So what people do is they'd enter the trade by first plotting their stop loss, and they choose their stop loss right below where the support is. So we can see support is here, and this trader actually put their stop loss a bit below to cover spread. But as you can see, when price touched support, it made a rally, and when the trader tried to get in again, price actually smashed through their stop loss past the previous support, and then price ended up rallying. So you can see in this case, a retail trader actually got stopped out here because their stop loss was right where the support is, and that's a no-go. Another thing you have to do is to make sure your stop loss is devised properly, and that means it's from a strategy. And in our strategy, we tend to give our stop loss some breathing room. So we go to our support and resistance levels, and we use methodic methods to determine how much leeway we're going to give. And so we usually have a 15 to 20 pip zone where we give enough breathing room for price. And so in our case, we'd have our stop loss somewhere down here. Now, if you zoom to the left, you can see it's a considerable way from the previous push from this level, but there's a reason why we keep our stop loss there. And if you look at the setup, it's still a 4.0 risk to reward ratio setup. So this is how you avoid getting stopped out. Choose your stop loss levels properly and make sure they're not at any support or resistance levels. Make sure you give them that breathing room.